everyone, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to go over a topic that is pretty much overlooked in a lot of spaces, and it's going to be notional value. And one thing about notional value is that it's really important to understand, especially when we're trading naked options and specifically selling naked options. So let's get right into it, and we'll break down notional value, which is essentially the value of a position or the position value when you take out margin and you take out leverage. So we're just basically looking at the raw value of the position, which you can also consider to be your max loss of the position. So we've got an example here, and let's say we're selling an out-of-the-money put contract. So we've got the put that's below the stock price, because again, a put contract is the right to sell 100 shares of stock. So if I'm selling the right for someone else to sell the shares to me, it's going to be out of the money if it's below the stock price, because if they can sell their shares at 50, there's not going to be any value with our out-of-the-money put here. But with all that said, there's still going to be value, extrinsic value in that put, which we can take advantage of by selling out of the money options. So let's say we've got this 48 put that's out of the money, and let's say to sell this put, it requires $800 of margin. So if I'm in a margin account, one of the benefits of a margin account is that it gives us additional leverage when we're selling options or even buying stock for that matter. So when we're talking about puts, we actually had a previous whiteboard, if you missed it, on buying power reduction. So if you missed that one, you can check it out by just clicking on Find Shows at the top and then scrolling down to Mike and his whiteboard, and it'll be there. And when we're talking about margin, it's basically giving us additional leverage. So instead of having our notional value of $4,800 less the credit received, a margin account is going to allow us to sell this put for, let's say, around $800. Now, these numbers aren't real. It's just an example here, but the issue is that the margin is not going to be reflective of the notional value or my max loss. So the margin is our theoretical max loss based on a certain standard deviation move, but when we're looking at our actual notional value for this position, when I'm selling a put at 48, and if I received a credit for it, I would basically have to buy the shares at 48. So let's say the stock price goes from 50 to 0. I would see a max loss of $4,800, as you can see from notional value. But since I sold the put and receive a credit for that, I can use that to offset my max loss. So what's important here is that margin is not equivalent to notional value when we're looking at naked options. And the notional value is going to be reflective of our max loss. And we're going to break down another example in the next slide here, which is going to make this very apparent. So on the next slide, we're going to break down a few S&P products. So a lot of the S&P products that we trade are going to be the E-mini S&P 500 futures contract, which is /ES. We're also going to look at SPX, which is a cash index that basically replicates the movement of that. And then we also have SPY, which is our ETF, and it has the smallest notional value of the three examples here. So what we're going to talk about is different notional values and different values for each point. So with the E-mini S&Ps, these numbers were taken a couple weeks ago. So this was back when the ES was at 20, 25, 50. So this is a future contract, and the value of each point is $50. So if I own the futures contract, it's actually tracked in quarters of a point. So it's going to be $12.50 per tick, but it's $50 a point. So let's say I own this futures contract at 20, 25, 50. If it goes to 20, 26, 50, I'm actually going to make $50. So to calculate my notional value, all I need to do is take the current value in points and multiply it by how many dollars that is per point. So we've got 20, 25, 50 multiplied by 50, which gives us $101,275. So that would be my notional value that I would be considering for that trade. However, in a margin account, if I actually buy this future outright, I'm not going to have to put up $101,000. I'm going to put up way less than that, because trading futures gives us that leverage and that margin to be able to do that. So we might see a different value in terms of buying power reduction that's used to place the trade, but our notional value here is this value here. So if we go to another example, we've got SPX, which is our cash index, and you'll see that our cash index is going to trade a little bit different than /ES. So usually it's a little bit higher, as you can see here. So when I took this number, it was 20, 30, 34. And with SPX, it's actually $100 a point. So with that said, when I take the point value 20, 30, 34, multiply it by $100 a point, I actually get $203,000.34. So that would be the notional value of that position. Now, what's interesting is that SPY, which is our ETF, is actually 10 times less the notional value of SPX. So this gives us a great understanding of 3 different products and different ways we can trade them. So if I'm in a smaller account, I might lean towards SPY. And as my account gets larger, I might start trading futures or look to SPX. But just for the example's sake, we've got SPY at 203.30. And this is also $100 a point. So when I multiply those together, my notional value is $20,330. Now what's interesting about this is SPY and SPX are $100 a point. However, 1 point in SPY is actually going to be reflective of 10 points in SPX. So it's important to understand that. So if this were to increase 10 points to 2040, you would see SPY only increase from 203 to 204. So definitely a good point to understand, and hopefully this gives us a better breakdown and better understanding of true notional value and what we're actually trading regardless of leverage or margin. But let's wrap it all together with some takeaways here. So first takeaway is that it's important to be aware of the true value of products we're trading. So like we just showed here, there's different S&P products that look to track the same movement, but when we actually break it down to the notional value, as you see in the second takeaway, they're very different. So it's very important to know exactly what we're trading and align that up with our account size, our risk tolerance, etc. So if I'm not comfortable with trading naked options, I might be able to define my risk, and defining my risk in positions such as those underlyings is going to give me a more defined max loss and max profit as well. So just understanding these is going to make us better traders in the end. And one last thing is that notional value differences are especially apparent in futures contracts. So for example, we just talked about ES, how that's $50 a point. Well, if we look at something like CL, which is the crude oil futures, it's actually $1,000 a point. So understanding those differences and then how they're completely different products is going to make us better traders and allow us to understand different strategies in different ways. So this has been our overview of notional value. Hopefully you enjoyed it. Thanks so much for tuning in. If you've got any feedback or questions, shoot me a tweet at @dotrade, or you can send an email to support. And we're actually done for the week, but we'll be back on Tuesday at 3:15, so we'll see you then.
Thanks for watching. If you like this video, give it a thumbs up. Click below to watch more videos, subscribe to our channel, or go to